Be Wealthy and Smart, episode 1196.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about why I'm not a fan of market timing. And I thought that some of the statistics and studies that have been done would be important to share with you in case you're not familiar why market timing doesn't work for investors in stocks. And I'm bringing this up to you because I just did a podcast about how I think in June we may have some trouble in the stock market. We may have a pullback. And I wanted to give you a heads up for lots of reasons. Number one, if I see something that's a possibility, I want to share it with you. But I'm not 100% accurate myself. So it's not that you take it as the end all be all of everything that's going to happen. It's just to put caution out there when I see potential points in the market that might be telling that we need to be a little bit cautious here. That hopefully helps you not dive headfirst into the euphoria when markets are booming and when markets are skyrocketing up, which makes you feel a little bit of FOMO. It's true that people tend to invest after markets have already risen, and that's the most dangerous time to invest. When you want to invest is on the dips. And I always try to emphasize that that's the time that you want to buy is when the market goes down. So if I can give you a heads up that we may have a time where the market may go lower, that to you should signal, rather than fear that you need to jump out of the market, maybe excitement that if you have some money to invest in the future, it might be an entry point for you. So it's all in how you look at it. But I wanted to share this study from Charles Schwab with you because it perfectly illustrates why we don't want to try to time the market. First of all, nobody can time the market perfectly. Believe me, there's hedge funds out there that have every investment advantage at their fingertips. They have bots, they have charts, they have services with spectacular big name people that they subscribe to their research. They have intimate calls with different companies. They have the biggest advantage of just about any type of investment. Because hedge funds make large fees, they have large amounts of money to invest in trying to make their investments do better and their performance outperform other investments. But even they have a difficult time timing the market with all those advantages. How can the everyday person do so incredibly well? For example, someone brought to my attention that they were pitched 10% quarterly returns and 40% annual returns. And I said, that's not possible, because even in his heyday, Warren Buffett, who was arguably one of the greatest investors of all time in the stock market, at his peak was averaging 26% average annual returns. So somebody messaging you saying they're going to get you 40% a year, I don't think so. They would soon be the richest person in the world if they could actually do that. So be careful with claims about market timing, but let's look at this Schwab example because they actually did the research here. They have 5 different ways that people may approach market timing. The first they call Peter Perfect, and that is a perfect market timer. If he had this incredible skill that he was able to take $2,000 in the market every year at the lowest point of the year. For example, he had $2,000 to invest at the start of 2001, and rather than putting it into the market, he waited and invested on September 21st of 2001, which was that year's lowest closing level for the S&P 500. Then at the beginning of 2002, he had another $2,000 to invest. He waited and invested on October 9th, 2002, the lowest closing level for the market that year. And he continued to time his investments perfectly every year through 2020. The second example is Ashley Action. She took a simple, consistent approach each year. Once she received her cash, she invested her $2,000 in the market on the first trading day of the year. The third example is Matthew Monthly. He divided his annual $2,000 allotment into 12 equal portions, which he invested at the beginning of each month. This is what is known as dollar cost averaging, when you invest the same amount every single month. And you may already be doing that through your 401k plan or an automatic investment plan, which allows you to deposit money into investments like mutual funds on a set timetable. The fourth example is Rosie Rotten. She had incredibly poor timing, or perhaps terribly bad luck. She invested her $2,000 each year at the market's peak. For example, Rosie invested her first $2,000 on January 30th, 2001, that year's highest closing level for the S&P 500. She received her second $2,000 at the beginning of 2002 and invested it on January 4th, 2002, which was the peak for that year. And then the fifth example is Larry Linger. He left his money in cash investments, which were using treasury bills as a proxy for cash, and every year he never got around to investing in stocks at all. He was always convinced that lower stock prices and therefore better opportunities to invest his money would come his way, so he didn't invest except in a cash vehicle. So what we're going to look at is how much hypothetical wealth each of the 5 investors accumulated at the end of the 20 years from 2001 to 2020. And Charles Schwab says they also looked at 76 separate 20-year periods in all, finding similar results across almost all time periods. So naturally, the best results belong to Peter Perfect, who weighted and timed his annual investment perfectly. He accumulated $151,391. So that's not a surprise because he was getting the absolute low every single year. But what is really interesting and most stunning is number 2, Ashley Action, who took a simple, consistent approach and each year invested her $2,000 on the first trading day of the year. She actually came in second in our example with $135,471, only $15,920 less than Peter Perfect. That small difference between being perfect and just investing the first day of each year is especially surprising because Ashley had no pretense of market timing whatsoever. The third best approach that performed almost nearly as well, earning $134,856, just a few $100s less than Ashley, was dollar cost averaging. So the monthly dollar cost averager did almost as well as Ashley, who invested on the first day of each year. Fourth place was what we call bad timing, or Rosie Rotten. She invested $2,000 each year at the market's peak, and her investment grew to $121,171, about $13,000 less than investing at the beginning of the year or dollar cost averaging, and $30,000 less than perfect timing. But the person who did absolutely the worst was the one who stayed in cash. They were so scared to invest and sure that something terrible was going to happen that they didn't invest at all in stocks. They just stayed in cash, earned some interest, and their account grew to only $44,438. Charles Schwab goes on to say, regardless of the time period considered, so meaning we did 20 years within 2001 through 2020, but they looked at 76 rolling 20-year periods dating back to 1926. And in 66 of the 76 periods, the rankings were exactly the same, with the same results as I shared with you. But in those 10 periods when the results didn't turn out the same, even in those periods, investing immediately never came in last. It was in its normal second place 4 times, third place 5 times, and fourth place only once, from 1962 to 1981, which is one of the few periods of persistently weak stock markets. And what's more, during that period, the fourth, third, and second places were virtually tied. They also looked at possible 30, 40, and 50-year time periods starting in 1926, and if you don't count the few instances where investing immediately swapped places with dollar cost averaging, all of these time periods followed the same pattern. In other words, perfect timing was first, followed by investing immediately, then dollar cost averaging, bad timing, and finally never buying stocks at all. So that's why I always say, don't try to time the market. It's better to stay in the market even through some of these downturns. Although they're scary, they can be a great buying opportunity. But the problem with trying to time the market is you not only have to get it right once, you have to get it right twice. You have to sell at the top or a peak, and then you have to buy back at the low. So you have to know where the bottom is and that the bottom has already happened. And very few people can do that. Plus, most people are feeling maximum fear at the bottom of the market. So when the market is actually bottoming and you should be buying, that's when you're sure that it's going to continue to be going down because there's maximum bad news and pessimism right at that point. So it makes it very difficult for people to buy back in, even if they are able to sell before a crash. And what in my experience happens is people who sell before a crash, they wait to get back in until the market has recovered. And what happens is more often than not, they end up buying back in higher than where they sold in the first place. So that whole exercise actually made them worse off than if they had just held through the whole downturn and rebound. Now, again, I want to stress the best thing you can do in a market downturn is to invest on the dips. I try to train my people in the VIP experience to buy the dips, whether it's stocks or crypto or any kind of investment, real estate, anything at all. You want to buy when there's a pullback. One of the most famous investors and most successful real estate investors of the last 100 years was Sam Zell. Billionaire Sam Zell just passed away about a week ago, but they used to call Sam the grave dancer. And the reason they called him the grave dancer was because he was a fan of buying when markets were extremely weak. So he would buy into real estate when everything looked terrible, and he would sell his real estate when everything looked fantastic. He believed that buying was a matter of buying opportunistically, and opportunistically for him meant buying on weakness and buying on bad news and buying in bad times, and then holding for better times. I like that strategy a lot more than market timing, but the most important thing you need to do is just invest. So rather than sit in fear or sit in the money market or sit this out, if you're scared, plan to dollar cost average into the market. So maybe you're not putting your whole amount of money in at once, you're spreading it out over a period of time. That means that when the market dips, you're buying more shares. And when the market goes up, you're buying fewer shares. But you're not buying at the peak and you're not buying at the low. You're buying somewhere on average in between. Because what this study should show you is it's not about timing the market, it's about time in the market. And that means staying in, staying invested so that your money can work harder for you and you can compound at a higher rate. And that's really what it's all about. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And all of my podcasts are available on my website at lindapjones.com/podcasts. And while you're there, sign up for my free report, 3 Easy Steps to Maximize Your Wealth Building. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.